But do want to broaden it out now and talk more about really what investors should be doing in this environment. Emily Roland is joining us, co-chief investment strategist at John Hancock Investment Management. Emily, it's good to see you. How do you protect yourself? How do you do risk management in this environment where you don't know where the next risk is coming at you from?
Yeah, Julie, thanks for having me this morning. There are so many cross currents driving the market right now, whether it's Russia, Ukraine, whether it's this elevated level of inflation, commodity prices soaring, and now the Fed set to take off on this new rate hiking cycle. So there's a lot for investors to digest, and really hard, we think, for them to try and focus on the intermediate term. But that's what we would try to do at this point. We still want to own a balanced mix of stocks and bonds. We do see stocks in a position to continue to do the heavy lifting in a portfolio right now. The fundamental backdrop is there. Next 12-month earnings estimates, which we watch closely, are moving higher. We're seeing nice earnings revisions, particularly here in the U.S. We want to continue to emphasize U.S. stocks in the portfolio based on better earnings growth prospects, better economic growth prospects here in the U.S., but we also want to be very, very mindful that the cycle is moving rapidly. With the Fed set to take off next week, so we want to own some value stock for that more economic sensitivity as the economy holds up here. But we also want to think about areas like quality growth, which should be able to show some market leadership as the cycle moves on, and as we have these more sort of modest levels of growth playing out here in the U.S.
Emily, we've talked in the past. You know, I love me tracking some S&P earnings estimates. I understand how that works and why people, of course, track it. But look, don't you think the S&P 500 at current levels is simply overvalued? A week removed from a likely first rate hike, oil price is still over $100 a barrel, and folks telling us that gas prices in the country might stay over $5 a gallon for many months.
Yeah, higher gas prices are certainly going to take a bite out of the consumer. But the consumer's coming into this in pretty good shape. We have $18 trillion in savings accounts. We have wages that are continuing to remain elevated here. So the consumer's in decent shape, but it's definitely going to take a bite out for sure and risk slowing the economic backdrop even more. But from a valuation standpoint, we actually see U.S. assets on sale right now. We started the year at about 21 times forward earnings on the S&P 500, and we're now at about 18 times forward earnings. So again, you see that negative price action playing out. Meanwhile, earnings estimates are moving higher. That's a nice resetting in PE ratios that we haven't seen in quite some time. So we're actually looking opportunistically at these pockets of weakness to add to positions in areas that we find attractive: U.S. value, U.S. mid-cap equities, some elements of the quality growth complex as well, as again, we see that fundamental support really being there for stocks.
You know, Emily, I just want to push back a little bit when you talked about the higher wages, because there's one number that really stood out to me today that I forgot to mention from CPI, and that's real average hourly earnings, and that's adjusted for inflation, and it fell on a year-over-year basis by 2.6%. Weekly earnings down 2.3%. So, you know, we continue to see this trend both because of inflation. Even if people are getting raises, those raises are being eaten away by this inflation. So how substantial a problem is that going to be for the argument that there is this solid base underpinning earnings in the economy?
Yeah, Julie, it's a great point. And I think the biggest challenge right now is how quickly it's happening. So we look at the CPI data that we just got for the month of February. By the way, that doesn't even capture what we just saw over the last couple of weeks in terms of this huge surge in gas prices. So it's going to happen very quickly. Right now, your paycheck's higher, jobs are plentiful. We just saw yesterday, and there's 11 million job openings in the U.S. So that gives a lot of power to the consumer, and they're feeling pretty good. But now we're starting to see data most recently that consumers are dipping into their credit cards to pay for higher gas prices. This is going to increasingly become a challenge. If wage growth cannot keep up with inflation, certainly it's going to start to create this tax on the consumer, which again contributes to stagflationary dynamic, and by the way, makes the Fed's job even more challenging.
Emily, let's tap into your stock picking expertise here. This Amazon news, 20 for 1 stock split, to me, strikes me as a pretty big story here. What do you do with an Amazon stock here in light of this development? Because the way I read it, you're going to have a lot of average investors out there looking at this as a potential once-in-a-lifetime opportunity into a mega growth company.
Yeah, the stock split doesn't do much to change the fundamentals. It's interesting. It's kind of a, as you know, old-fashioned way of bringing more mom and pop investors into a particular stock. They're saying it's offering their employees some flexibility around the way that they're contributing to or investing in the stock. I think the buyback story might be even more relevant here. Technology companies have taken it on the chin this year, down about 15%. If you look at S&P 500 technology companies, meanwhile, the fundamentals are there. We talked about quality. It's great balance sheets. It's lots of cash on their balance sheets, good earnings stability, great return on equity. And we're seeing companies like Amazon start to take advantage of that huge amount of cash in terms of, initiating these buybacks. And I think it's going to be interesting to see if other tech companies follow suit to really bring light to the fact that there are great fundamentals there and really kind of get away from this sort of macro picture where these longer dated assets like technology companies are really struggling amidst an environment and where rates are backing up. So I think something notable there to watch as far as the entire technology complex.